when we talk in terms of cyclicality, we're not thinking in terms of cyclically sensitive to the economy, but we're talking about reimbursement issues, and that was an issue before in the hospital sector. You have investments, Ben, you have investments in the hospital sector. You knew reimbursement was an issue then. What's your position relative to your earlier thesis at this point?
On the hospital sector?
Yeah.
Yeah, it's a good question, and one, quite frankly, that I've been a little bit schizophrenic with about it as an investor in the healthcare space over the years. Because you think about it, on the one hand, you have this big fixed cost, kind of archaic infrastructure in place, where new technology is taking procedures that have historically been done in this big fixed cost setting, and then taking it to the outpatient setting. And at a very theoretical level, you could say, hospitals are archaic and you should have this new medical mall, and that's what people are talking about. I'm not sure you ever get there in our lifetime, but just suffice it to say that it is a big fixed cost infrastructure with a lot of negative trends against it. You got outpatient setting putting pressure on volumes, and then you have the cost equation, which is you have medical, you have the big cost, the big component of their cost is salaries, wages, and benefits. Due to labor shortages there, that's going up 4, 5, maybe 6%. You have medical supplies going up in the high single digits. Guys like Nat buying companies like Biomet and pushing through pretty big pricing increases to the hospital setting. And then you have Medicare, which is basically only giving them basically about a 3.5 a market basis, market basket less 50 basis points pricing increase. So, hospitals are under a lot of pressure. You add on top of that this bad debt phenomenon where there's just fundamentally there's less insurance out there, right? You have more uninsured, and then you have less insurance with benefit buy-downs. So what that means is people are showing up in the hospital, can't pay. The people who have insurance have more responsibility for the dollars, and they've shown over the last couple of years they're not going to pay either. So bad debt's gone up by between 200 and 400 basis points, depending on how you look at it. So, why invest in this space? First of all, our thesis is that a hospital is, you see one hospital, and you've seen one hospital, and each one's different. And for us, while there's these macro themes going across, we do fundamentally believe that long term, these are, big components of the healthcare system. They're important parts of their local communities, and care is going to get delivered in the hospital setting, despite some of these current exogenous trends that are going on. And our view is that if you invest in the right hospital system, and we define that principally as a hospital system that has large market share in its market. And if you have a large provider in a market where a health plan cannot sell a health plan without having you as a provider, you have a fair amount of leverage. So, there's a hospital in a crowded city where they're one of 10 players. That's a difficult market. If you're one of 2 or 3, you have 30, 40% market share. You're one of 2 or 3 players. You're going to be able to get the managed care pricing increases to be able to offset some of these other trends, and you basically have not a monopoly but an oligopoly. And that was really our thesis behind our attempt to take Triad private. Ultimately, that didn't work out because we got topped by a strategic. And in the interim, we've taken a slightly different approach where we've kind of looked at those macro trends and said, okay, there's going to be pressure on the not-for-profit hospital systems, and we want to provide another solution to them. And we formed a company with the ex-Triad management team called Legacy Hospital Partners. And the sole goal of that company is not to go buy hospitals that are owned by other not-for-profits or for-profit companies. It's to partner with the local communities, these not-for-profit health systems, because historically these not-for-profits had 2 options. And for those of you who don't know what's going on in that world, it's basically overall there's the haves. There's some big hospital systems that are making a lot of money, and then there's the have-nots, and the vast majority of them fall into that second category. And they historically have had 2 options. One is to maintain the status quo, where they're going to continue to languish because they don't have the capital to invest in their system, and they're going to start losing doctors. There's going to be outpatient migration, or they're just going to flat out lose market share to other players in the market, or they could sell to a for-profit. And neither of those options really helps them fulfill their mission. These not-for-profit companies have a mission of providing high-quality care to their local communities. So we formed a company along with the ex-Triad management team to provide a third option, which is to joint venture with a capital partner. So what we do is we have this not-for-profit health system contribute an asset, we invest capital, we give them liquidity to pay down debt, solve whatever liquidity they need at the parent level, and then we invest a lot of capital down at the hospital, at the facility level. And what that enables you to do is you go from a situation where you're in a spiral downwards towards a situation where you invest in capital, you start recruiting physicians, you start gaining market share, and then those conversations with the managed care players start to be a little bit different. So that's the way we've chosen to play the space, where you have negative trends going on, but we think that this is a unique way to play it. And it also it's benefited, the other benefit of this particular strategy is that we're not dependent on leverage. So we intend to invest $500 million into this sector, which is difficult to find a deal of that size with the current credit markets out there.